Ashok Wadhwa of Ambit Capital is with us right now. Ashok, morning. Thanks for joining in. What did you take away from this Wockhardt episode? Do you think other Indian companies are at such balance sheet risk given their FCCBs and the kind of debt they may have piled on to buy large companies overseas?
Even before I answer that question, I continue to believe that Wockhardt is a very good example of a domestic Indian company that ventured out to build itself into a powerful mid-market global corporation. I continue to believe that the fundamentals that have made Wockhardt what it is are very strong in terms of their people, their research capability, their product, and their distribution in the marketplace. We all know that the exuberance of 2006 and 2007 effectively meant that several Indian promoters ventured out, largely because of ease of rules and then supported by ease of money availability, to make global acquisitions. Some of those acquisitions, have paid off well in terms of delivering high value. Some other acquisitions are struggling a little. Most of these acquisitions were either funded by private equity and in several instances by debt. And the idea when these acquisitions were made was that given the attractiveness of both the equity and the debt market at that point of time, very soon a integrated organization, kind of integrating the global acquisition with the domestic business would create several synergies, and it'll be so easy to raise additional capital and pay back the debt. So the debt was really borrowed from that perspective on a short-term basis, bridge funding. Markets have gone a very different route. The debt market has gone a very different route. The equity market has gone a very different route. There is no new opportunity to raise capital. And therefore, I argue that Wockhardt is a classic example of a very well-run company that in some ways was affected by market exuberance. And some of those acquisitions may not have paid off. And the debt is today an overhang. Happens in all the countries, happens at all points of time, can happen to any company in any industry.
Ashok, hi, morning. I think one of the concerns is how many companies within the Indian stock market might have the same problem on their hands. So on both these counts, FCCB issues and on debt issues, how worried would you be on how many more companies could be going down that road?
I mean, clearly Wockhardt is the first one that has stepped out and said that, we need to restructure ourselves and has acknowledged the stress on the balance sheet. I'm very sure that there are several other companies that follow the same stress. The key issue that we need to understand is the business fundamentally strong and is the sector still vibrant? And if the business is fundamentally strong and the sector is vibrant, then some element of acknowledgement followed with some element of serious restructuring negotiations with both FCCB holders as well as lenders will provide the basic amount of time that these companies need. So if your question is, are there more companies like Wockhardt which have a stressed balance sheet? Answer is absolutely yes, whether they acknowledge it or not. There are several other companies like Wockhardt which have a stressed balance sheet. Question is, are these promoters going to come forth like Wockhardt has, acknowledge that they need to restructure? Because if they do, and the business is fundamental, it's a matter of time before they ride the tide.
Corollary to that, Ashok, is what will happen to the banking system? I mean, earlier the fear was that, yes, bank NPS will go up a bit because of real estate companies, but if some of these large, well-run companies also start restructuring their debt because they can't pay up right now, what happens to the asset quality of the banking sector? And do you think fears on that count are legitimate?
Well, let's first break up and look at where the stress is coming from. A large part of this stress, is coming either from FCCBs or funding that was raised to be able to make global acquisitions, which is funding that has largely been provided by large global banks. I would argue that the domestic banking sector in that sense, either because of regulatory environment or because of their own conservative nature, has been a lesser of a participant in this whole process. And I'm not saying that they're not a participant, I'm saying they've been lesser of a participant. Therefore, I would argue that the stress that is being caused on these balance sheets, and the natural effect of the restructuring is going to be largely on the global banks and to a smaller extent, of course, on the local banks. And again, I think the companies that face that stress are well known. The banks, at least the domestic banks that have provided support to these companies, are also well known. And I would believe that to some extent, if the banking sector continues to be less favorite of the market, it is because the market has built in that discount for some of the stress flowing through the restructuring exercise onto the balance sheets of the bank itself. And again, remember, we are not necessarily talking about write-offs at this stage. Hopefully, as we saw through the 2000-2002 CDR process, the banks actually realized significantly higher value in many of the companies where they had supported a CDR, corporate debt restructuring. And I would argue that the eventual realization of their debt was at a premium to what they had expected or they had restructured originally. Of course, that was largely because the market turned so positive between 2003 and 2007.
We could be talking about a ballooning NPA problem though, Ashok. I remember speaking with someone from Morgan Stanley who said 6% is probably the NPA figure we'll have to live with, and it's going to be accentuated, if not heightened, for some of these private sector banks. On that front, are you worried about how private sector banks might tide through the next couple of quarters? Because evidently from the Wockhardt episode, we haven't seen the worst in terms of leverage issues.
Well, one thing is clear, that if there is stress within the Indian banking sector, it's more likely to be within the private sector banks than the public sector banks. For two reasons. I think public sector banks in that sense have been more conservative in their lending policies versus the private sector banks. And two, the size of the public sector banks is large enough to be able to withstand some of this stress. On the other hand, private sector banks have obviously relatively smaller balance sheet, and they have been, more active participants in this whole process. So I would argue, I would still continue to argue that the largest stress out of this restructuring is probably going to go to global institutions. Within the Indian institutions, the stress will be higher on the private sector banks than on the public sector banks.
Where do you stand in that context, Ashok, on the context of the previous question that I asked you, on this debate which is raging in corporate India on whether MTM issues need to be shown up now, or can they be deferred for 3 to 4 quarters? Because it's very material to what kind of numbers will come out over the next few quarters from India Inc. Where do you stand on that?
But my view is that there needs to be a mark-to-market recognition for sure. I cannot see the balance sheet reflecting a true and fair position, for that matter, of profit and loss accounts reflecting a true and fair position, unless there is a market recognition. Question is that, do I need to do all of the mark-to-market in one go at one point of time, or do I need to spread it over the life of the liability? And there are two issues on this. I'm no expert on the accounting treatment, but I would argue that mark-to-market amortized over the life of the liability is probably a better way to recognize this, because we do know that we are living in a volatile market. We've seen the dollar move from one end to the other end vis-a-vis the rupee, that's causing a lot of the stress at this point of time. So I'm a supporter of mark-to-market, but I'm a supporter of mark-to-market on a amortized basis versus on a one-time basis.
Okay, that's the nitty-gritties of companies and balance sheets, Ashok. What about the market? It's been, interesting is another word to put for it these past 10 days.
Well, it has been interesting. We keep hearing different versions of it. Some say we are in a new bull phase. Some say the bears are waiting to, hug the market again. I personally believe it's very difficult to predict anything other than the fact that we are in a range-bound market. Whether that range is from 9,000 to 11,000 or 8,000 to 10,000 is anybody's guess. But we are in a range-bound market. What worries me, of course, is the volatility and the speed with which the market is moving upwards and downwards. That cannot be very healthy for the market at this point of time.
Thanks, Ashok. Appreciate you joining in as always. That's Ashok Wadhwa of Ambit with his views on many things. With that, we